Okay, good afternoon here in Israel and good morning in New York. We're here with Dean Sam Chandan, who's the Dean of the Shack Institute in NYU. And I actually understand that we can add another title to your very impressive title as it is.
That's right. This summer, we announced the establishment of the NYU Institute for Cities and Real Estate in Emerging Markets that will be based at our Shanghai campus. That institute will offer master's degrees in real estate, but the focus of those programs, including our research agenda, really is on emerging markets, mainland China initially, but then Belt and Road markets and other parts of the world. And so the focus will be a little bit different from what we're doing here in the United States, but we're very excited about it.
That sounds like a very exciting new initiative, and I can't think of anyone more appropriate to head that initiative. So congratulations for that.
Thank you.
Before we start talking about the interest rate and the effect on real estate, if you can just tell us a little bit about your background, how you got to be at NYU and your very long and impressive tenure as a real estate investor and an academic.
Yeah, thank you. So I've been splitting my time for much of my career between academia and the private sector. I've taught at Dartmouth College in New Hampshire, but have spent most of my academic career at the Wharton School in Philadelphia teaching real estate finance and investment analysis. At the same time, I focused a lot of my attention on the private sector in real estate data and research companies that in their early years were really the pioneers in bringing more comprehensive, systematic data sources to our industry. More recently, I've also been involved in the investment side of real estate, principally at Capri Capital, where the portfolio has had exposures or included principally multifamily assets, rental apartment buildings in the United States, but also at various points retail and hotel, and where we've had investment platforms and interests in sub-Saharan Africa and India. About 3 years ago, I came to NYU to head up the Shack Institute. Shack is the largest real estate program in the world. We have about 850 students across 3 graduate degree programs, 3 different master's degrees, one focusing principally on finance, another one on development, and another one on construction, and an undergraduate program as well. Apart from the degrees, we offer a very rich array of corporate and executive education, as well as continuing education programs for working professionals in the real estate industry. One of the innovations in the last several years has been to expand the geographic scope of our offerings, certainly to begin offering programming on the ground in Shanghai, but also through our online platform to offer individual courses on very specific topics and certificate programs that are accessible and available to people around the world. The content of those programs is not focused on New York per se, as much as either global real estate, global capital flows, global investment trends, but also finance, development, construction, prop tech, data analytics, in a way that is relevant for participants in the programs, no matter what part of the world they're interested in.
Well, I think I told you that I did my master's of business at Wharton, but I wasn't lucky enough to take any classes with you. But a lot of my friends did, and when I tell them that I'm going to speak with Dean Chanden, there's like a little vibe in the air of excitement, maybe a little bit fear. But we are going to talk about some of the sectors that you mentioned in the U.S. But as you know, we are conducting this interview from Israel, and you can see this beautiful virtual background of the sunset over Tel Aviv. And I know you've been to Israel at least once. Can you tell us a little bit about your experience of coming to Israel and what you saw when you were here?
Sure. I have to say, and I've been many times now, that it's one of the most amazing places on earth. Much of my time in Israel has been to see the country and to spend time in different parts of Israel. Every visit, I make a point to go to Jerusalem. I've not spent as much time from a business perspective as I have just from a personal from a personal motivation, a personal perspective, but from a real estate perspective, Israel is also just fascinating. There are very unique issues around development. One, given density, given a very unique environment for land use regulation, given the changing needs of the population. The nature of resource availability, whether it be materials or labor. There's so many unique and interesting aspects to the market that I think it's a fascinating laboratory. Certainly, it's also a critical place for the creation of new property-related technologies. And so when we think about real estate tech, investors, real estate tech, innovation, entrepreneurship, there's just so much happening in Israel that it's visits to Tel Aviv are always just so fascinating for me. We've been very lucky here in New York and at Shack to host visitors, from various companies, startups, established firms in Tel Aviv, and that relationship is very important. Shack was founded by Larry Silverstein 52 years ago now. And I have the very good fortune of being able to work closely with him in sharing ideas for how we advance the Institute and grow our programs. And Silverstein Properties, in fact, has taken advantage of access to the bond market in Israel to raise capital for some of its projects. So I think the ties are very close. Both personal and professional for me, and I look forward to every visit.
Good, and we look forward to hosting you. I can't promise this kind of sunset every time, but
not every day. Not every day.
So before we dive into real estate, you are an economist by training. So I'd like to ask you, what do you think we can expect from the interest rate environment in the short, medium, and long term, where we are today?
So as recently as perhaps a year and a half ago, the Federal Reserve in the United States was in the bias was to tightening monetary policy, and we were seeing over the previous couple of years, a fairly steady pace of rate increases. It's important to note that those increases have been at the very short end of the yield curve. The Fed exerts effectively control over the Fed funds target rate, very, very short-term rates. But what's important here is that as we look out longer on the yield curve, to the 1 year, the 5 year, the 10 year, the degree of the Fed's influence is significantly less. And so it looks less like control and it looks more like influence, but that degree of influence has been fairly limited. Now, the way that then that is expressed over the last couple of years is that although the short-term rate has increased, the long-term rate has not moved in kind. There have been much more measured increases in the long-term rate. That has looked like a flattening of the yield curve and more recently an inversion of the yield curve. In terms of the Fed's bias, I think what we see now is that of late, the Fed has been more accommodating in monetary policy. They've been a little bit more dovish. And by that, we mean that they've engaged in decreases in that target rate, or the target rate has come down. So the underlying cost of capital for that very short-term rate has become lower. We still have a very flat to inverted yield curve, and that is causing some anxiety in the market. Historically, inverted yield curves in the United States have been not a causal factor, but have been an indicator that the economy is poised for a contraction. And we do see that most economists on both sides of the political spectrum and everywhere in between, are of the view that in 2020 or 2021, we are likely to experience a contraction in the U.S. economy. No economist is going to be so bold as to put an exact date or time on when that inflection will occur, but expectations are that very likely within the next probably 12 to 18 months, that period of contraction will begin. A couple of important things here. One is that we've not seen much in the way of upward pressure on cap rates and valuations, or down pressure on valuations in the United States. And in part, that's because that very short-term rate is not always the most relevant for us in real estate. When we're thinking about long-term financing, long-term investment, the relatively longer-term rate is the one that is the more relevant for us. And as that the movements there have been more limited, we've seen, again, then more limited pressure on costs of capital for financing or equity. So this becomes important for us as well, because we should not make the mistake of thinking that real estate is this time around somehow immune to increases in the underlying cost of capital. It's more that the relevant underlying cost of capital for real estate has not seen a significant upward move. The other thing to keep in mind, because there is so much talk right now around when will that contraction happen, how deep will it be, I think economists are thinking a lot about what will be the proximate cause. Although this has been the longest expansion in modern U.S. economic history, that in itself is not a reason why things need to turn. There's no finite life associated with an expansion. In theory, it could go on for a significantly longer period of time. So we're looking at what are the proximate causes, whether it's geopolitical issues, whether it is increases in the cost of goods because of a trade war, just as important, limitations on the growth in our exports because of trade disputes. Could there be a loss of consumer confidence domestically for any of a number of reasons? Could there be increases in debt levels in some asset classes in the U.S. economy that prove to be unsustainable? And that is a very real issue for us. And so when we're looking at things like corporate debt, when we're looking at student loans, these are areas where economy-wide we've seen big increases in debt levels. And in the case of student loans, certainly a deterioration of the performance of those loans, higher delinquency and default rates. In the area of corporate debt, increases in the actual volume of the debt, not so much weakness in its actual performance, but these are all areas that I think we have to watch as potential proximate causes for that downturn. But I advise folks to keep in mind when we get very nervous or worried or anxious about a downturn is that historically the downturns, even the most painful ones, last for relatively short periods of time as compared to the expansions that follow. And this was the case even with the great financial crisis. The contraction in the economy lasted roughly a year and a half. But the period of growth that has followed has been much, much longer. And so rather than fixate on the downturn, that's not the end of all things. That is something that we have to manage through. The firms that are the most successful are the ones that anticipate the downturn, that are positioned so that they're not caught in a difficult situation in terms of needing to refinance loans at the wrong time, needing to dispose of properties sort of when demand is weak. They've been thoughtful about tenant retention, so they're not losing tenants or facing undue levels of competition in a way that they're unprepared for. But firms that anticipate some of the challenges that will come with a downturn, and perhaps even are planning so that they can take advantage of weakness in property prices, so that they can be a buyer when prices are low. those are the firms that, that again sort of are able to see the light at the end of the tunnel, are the first to capitalize on the return to growth in the market, and that end up doing very well. And so again, what we suggest to a lot of investors and lenders in the market is take that positive view, be well prepared for the downturn and the various issues that might arise. They can be related to how you manage your debt, the timing of your exits, how you retain and manage your tenancy during that downturn. If you can really have a strong handle on those, then you can manage your way through that downturn and be one of the first to capitalize on the return to growth on the other side.
So thank you. And just so we put ourselves on our timeline, because you mentioned that we are in the longest period of expansion. Last time we met in person, or the time before, was about, I think, May. And I remember looking at that graph because the expansion started in June of 2009.
That's right.
And so it means that we are now about 3 months longer than the longest expansion that U.S. has ever experienced, which is 10 years. Yeah. And one of the things that you mentioned, which I think is really important to remember, because we are going to focus on lower interest rate, is that if we look at the statistics, the lowering of the short-term interest rate impacts the long-term interest rate only by a third or so on average. And that's going to be really important when we talk about the effects on the lower interest rate on real estate. But if we're talking about that, so the most direct result of lowering interest rate in real estate industry is obviously the cheaper cost of capital, and you mentioned that. But we are in a time where there are forces that are pulling in different directions in what we are seeing as a very pricey environment. What are your predictions for the effects on the real estate in the short term?
Yeah, so I think that real estate prices, particularly for high quality properties in the largest markets in the United States, are generally perceived as being fairly aggressive. And that's not to say that there aren't good deals out there. It means that you have to work hard to get those deals. But what we generally see is that when good quality properties become available, there is an abundance of equity that is looking for those opportunities. And so bidding for properties can be fairly aggressive. We see that investors are looking at secondary markets, so relatively smaller markets. They may not be smaller in terms of population, but they may be characterized by a lower level of liquidity. They may be markets where there are greater complexities around exit strategies as a result of lower liquidity, or part and parcel of lower liquidity. Maybe markets where it's more difficult to arrange financing to build out your capital stack. But where those markets inevitably offer less competition and higher yields. So we do see also investors looking at a wider range of asset classes. And so whereas, early in the recovery, 10 years ago now, investors may have been very focused on office first, and then apartment, and only later on, retail, hotel, industrial, and certainly retail, having its own, a whole set of other issues that it's grappling with, and some types of retail doing just fine, some types of retail coming under tremendous pressure and needing to be rethought. But we also see investors looking at a wider range of non-core real estate asset types, and so seniors housing, student housing, data centers, industrial fulfillment centers, being amongst the property types that I think are certainly getting a lot more attention from investors during this cycle than they have in the past, and are attracting a great deal more capital. Overall, I think we do have some large institutional investors in the market that do have access to capital that may not be in any particular rush. They're more patient money, and they're looking at the market today. If they see aggressive bidding for a particular asset, they're not under so much pressure that they're going to try and outbid every other dollar there. They're in a good position to wait 12 months, 18 months when prices are perhaps a little bit lower because some of that competition moves to the sidelines. Anyone who needs debt is a little bit constrained during a downturn. And so that firm that has access to significant dry powder, undeployed capital, that timing may suit them very, very well. But overall, I think that and there are going to be differences in nuance of how people characterize this. I'll describe pricing for the highest quality assets as being aggressive. Other folks will feel that aggressive is too strong a word. The prevailing sense is that pricing is, let's say, at least healthy.
Yeah, and every time I go on a visit either to New York, London, or Paris, and I meet a lot of real estate investors and developers, I always try and kind of come out with one strong point or theme that I overheard. And I think when I was in New York in August, the term I heard the most was dry powder. Everyone was really chasing after those commitments, even though they knew that they might not be able to invest in the short term. Being able to have those strong commitments is going to let them to not give them the opportunity to take advantages of maybe some of the lower pricing that we're going to see. You talked a little bit about cap rates, and we are really in an environment where cap rates are extremely low, and interest rates are maybe not correlated, but have some link and influence on these cap rates. If we're seeing even lowering of the interest rate, does that mean that cap rates are going to go even lower? And would that mean a bubble?
Yeah. So I think that when we're looking at cap rates, those longer term interest rates that have not moved as much, are probably a better benchmark for us versus the very short term rate. And so, there has not been, as you point out, a lot of upward pressure on, the long-term treasury yields as our benchmark or the long-term cap rates. Cap rates have not moved up very much. There are certainly isolated sectors or instances. There are some types of retail where the density of investors and lenders, there just aren't as many people competing for those properties. There's a perception of significant risk that's driving a premium, and you'll see some cap rate increases. Overall, cap rates remain very low by historic standards. And so, the question whether or not they'll come down, there's not a lot of room for them to come down. And I think what you see there is with this undeployed capital and sidelines, although there is a lot there, a lot of that undeployed capital is patient and will wait for conditions to adjust a little bit. I think if we were seeing all of this capital being actively deployed, if the money was, I won't call it. So there are sometimes less diplomatic terms for the money that will chase after any deal, but I'll say that if the money was less patient, or if there was a significant diminishment or lessening of risk tolerance, so if of risk aversion. So people were becoming very, very tolerant of risk. So we were seeing a lot of this undeployed capital really chasing after deals. And the market getting a little bit nutty, then there would be downward pressure on the cap rates. We could be concerned about that. Overall, though, I think the money has been fairly disciplined, and so although it's there, and although there are a lot of bidders for properties, don't really see cap rates going lower from where they are right now. The other thing that's sort of helpful here is that the underlying labor market drivers of space demand are still pretty strong. So when we look at the U.S. labor market, the unemployment rate is low. Wages and salaries are growing. We're not actually creating, an unusually large number of net new jobs every month. If we look earlier in the cycle, we were creating, more new jobs. But part of that reflects that the labor market is tight. there are lots of jobs open and available. There's a particular data set that we use, the Job Opening and Labor Turnover Survey, JOLTS. And I think what that shows is that we've got lots of jobs open. Firms are actually having a hard time filling a lot of those jobs. Anecdotally, that'll sometimes be characterized as a skills mismatch, where you look at what's available, the skills that are embedded in the segment of the working age population that's disengaged from the labor force, and there's not a match there. There's also a spatial mismatch in some cases. And so when we look at where the jobs are and where folks are that are looking for work, they're not necessarily in the same place. I think we also have an issue around housing affordability. And this is something that folks in New York, all of the major coastal and fast-growing tech markets here in New York are thinking about. I think it's an important issue for us, in Tel Aviv as well, and other parts of Israel, that the affordability of housing, no matter what type of housing, whether you're looking at owned housing or rental housing, the availability of affordable housing for the workforce. And we refer to this here, in the United States sometimes as workforce housing. We're talking about policemen, teachers, firemen, folks that are serving the community, young professionals that are a little bit earlier in their career, the availability of affordable housing options for them. And I don't mean, sort of technically affordable, the units where the government might be sort of, setting the rates through some kind of, program that will differ from country to country and jurisdiction to jurisdiction, but simply, an apartment that I can afford, given my income. We've seen a lot of stress on families in the United States and certainly elsewhere over the course of this cycle. The last 6 or 7 years have been particularly difficult. There's been a lot of pressure on families' budgets, and that is, that's constraining, growth in some areas. But overall, the labor market is strong. Wages are growing for many occupations. We have not brought enough new supply online, which is part of what's driving this, this price pressure. It comes back to some of these labor market dynamics. A big one for us, and again, I know it's not just in the United States, is that there's a shortfall in the availability of skilled construction labor. So construction costs have been rising rapidly, materials and labor costs. That's made it difficult for us to bring new supply online in areas where we need it.
So, and before we go and talk about the multifamily sector, which is something that you touched on when you talked about workforce housing, I really want to take a moment to highlight what you spoke about, this patience that the institutional investors and that's also affecting obviously the private equity funds, the lenders, because that's probably a lesson that we've learned from the last economic crisis. And if that is self-regulation or actual some government and agency regulation, I think that's going to make a very big difference in what we're going to see in the next cycle. Because when we're talking about this this slowdown in the economy, I don't think that there's any economist that is predicting anything like we saw in 2007, 2008. And that's really good news for all of us.
Yeah, I think you're right. That the consensus is that whatever that proximate cause ends up being, so whatever the set of influences that come to bear that ultimately prove to be the drivers for that turning point in the economy, that we're not going to experience a downturn of the order of magnitude or duration of the great financial crisis. Okay. And so this, all things being equal, our baseline expectations that this will be a milder downturn for the economy. But that is good news. The other thing I think also is that, and this is sort of, to the, for most of us, really from a policy perspective, this is good news. It's not good news for distressed asset investors that with so much undeployed capital that perhaps will seek to deploy during a downturn when prices are weak. We don't expect to see a decline in prices that is comparable to what we experienced during the financial crisis. there's just a lot of capital ready to come in. And so, when you think about what leads to sort of dramatic declines in prices in real estate, it's all of a sudden all of the debt and a lot of the equity disappears. There are no buyers out there, but there's a lot of properties that need refinancing, or that where the timing around your exit of your fund requires that you dispose of an asset. So you've got properties available for sale, not a lot of buyers, and maybe lots of people who want to buy and who know from previous cycles that it's a good time to be a buyer, but they don't have access to debt, so they can't be. That dynamic, I think, will not be as extreme during this upcoming cycle, because you do have all of this undeployed capital, as you've described, that is ready to say, all right, now I can come in.
Thinking about what the factor that will eventually or may cause the beginning of a downturn, I know all the real estate investors and professionals are sitting there and saying, well, as long as it's not us again, because that was attributed to the last cycle. I want to touch a little bit about multifamily, because that sector has seen a really exceptionally strong period, fueled by attractive agency loans, investor demand for low-risk investments, and strong demand for rental units from both Americans who are either didn't want to buy a house, maybe they couldn't afford it. Do you think this directional change in interest rate will affect the multifamily sector, which has been seen as such a strong and safe place to put your money at?
Yeah. So I think that the underlying demand drivers for multifamily space in the United States look very strong. The nature of demographics, household preferences that you described, really are quite favorable for the foreseeable future to the multifamily sector. That being said, as millennials age, their preferences change. They start families. It would be incorrect to say that millennials never want to get married or have kids. They're doing it later, but they are doing it. And what we see is that there are certainly some metropolitan areas around the United States where there is an abundance of Class A luxury buildings in the urban core, with studios and one-bedroom apartments that really were a good match to younger millennials. And those, that's been a lot of what we've been building over the course of this cycle. As we look at those oldest millennials and their preferences, they start to care about access to good quality public schools. They want a relatively more suburban lifestyle. They don't necessarily want to move into a traditional suburb, but a transit-oriented community that gives them the best of both worlds. There are some amenities, some restaurants, some retail. It's very close to a transportation hub, light rail to get you, give you good access to jobs, but it's not quite urban. They need a little bit more space. Those transit-oriented communities, I think there's a lot of demand there, and we've not seen, quite as much building. We've not seen as much building in what we would think of as sort of, the Class B space. We've not seen as much building in small multifamily, where you've got relatively smaller buildings that have fewer internal amenities to the property, right? It's not about sort of the Tesla charger and the pool and the doggy spot. It's more about, and the rooftop terrace, it's more about larger units to accommodate larger families, and location, giving access to external amenities like, a park or a playground or a school. We've not seen as much of that type of building. I have to say the agencies here in the United States, Fannie Mae and Freddie Mac, have played a very, very important role historically, but even more so this cycle in ensuring that there is financing available for relatively small properties, and so that there's what they were, what lenders might refer to as small balance, but broadly we would think of as small assets. Has there's more to be done there. And again, from a policy perspective, as an academic, building more small properties is part of the solution, or part of the way that the private market can address some of the real affordability challenges that we've got in the market. It's not about necessarily the luxury building with lots of amenities as much as the property that's really designed to cater to the needs of growing families.
And you've touched on two really important points that might actually be pulling us in interesting directions. One of them is the fact that new construction has been limited, one by less debt for construction, and also some of the municipalities just kind of slowing down on the amount of new approvals. On the other hand, whatever has been built usually has been built to kind of not the best use necessarily, but the most expensive use. So a lot of Class A, smaller units with a lot of amenities. Do you think that for those types of units, we've kind of reached a ceiling where we're going to see maybe even a crisis on this type of kind of Class A plus, almost luxury multifamily?
So I'd say not on a national scale. We have to look at each metropolitan area and each urban core individually. And there's certainly some where I wouldn't characterize it as a crisis, but we're going to have some investors out there that are not going to meet their goals in terms of how they grow income, in terms of the returns that they generate. There are certainly some markets where we need sort of that smaller property more than we need another large one. You're absolutely right in your characterization of the supply side of this. There are a couple of different factors at work here. There's labor, land or lots, and then local zoning that have all played an important role here, and then lending, I would say, is the fourth. So with labor, significant increases in the cost of skilled construction labor. We've not seen as many people go into skilled construction trades over the course of this cycle. And part of that is the lingering impact of the housing crisis, which the housing market now peaked 15 years ago. It's in the rearview mirror, but it's had a long-lasting impact on the perceived attractiveness of going into skilled construction labor. Wages have been rising in a way that should attract more people into the skilled trades, but there's still real shortfalls there, and there's a lot of wage pressure, and that's making it more expensive to build and limiting new construction activity. In terms of land/lots, the availability of land in a lot of markets is constrained either by regulation and zoning, or just because the urban core is full. The third being local zoning. There are in many markets a strong push against zoning that would allow for higher density. Or that would allow for relatively more affordable units. A lot of people, particularly if they're relatively more suburban, they don't want to see a lot of rental housing, in their neighborhood. They don't want to see relatively more affordably targeted units. And that's not the case everywhere, but it is a constraint in some parts of the country and in some jurisdictions. And then the fourth being, as you described, lending, and we don't want to miss this one. Banks and other lenders have come back into the market. In the United States, banks are the primary source of construction lending. And in part because of the way that construction loans are regulated or priced in terms of the kinds of reserves that banks have to set aside, in part because of the lingering impact on banks' risk tolerance, the losses that many banks took on construction loans. What we see is that the construction lending has been less available than it has been in the past. The convergence of these different things has meant overall less construction. There are exceptions. Certainly, multifamily overall, we've seen more construction than for other property types. It has been focused on urban Class A. There are isolated metropolitan areas where we can look at instances. In New York City, we've had an office building boom. Hudson Yards is the largest private sector development project in U.S. history, and it's extraordinary. But it reflects sort of a very significant addition to the office inventory. Folks will, I think, quite correctly characterize it as addressing in part the infrastructure of or the inventory of office buildings in New York City has been aging. It's a very old office inventory. We needed new inventory, but it does go to show that that there are there are projects happening. There is construction happening. When we look at the aggregated numbers, it doesn't look like a lot. What you described with also a lot of the building activity being at the very high end, we see that most clearly in the single-family home business. So when we look at single-family freestanding homes, a lot of high-end construction, not a lot of single-family homes being built for that first-time home buyer or that income-constrained home buyer, perhaps someone who lost their home because they defaulted on their mortgage during the financial crisis or the housing crisis, who's now able to get back into home ownership. Not a lot available for that home buyer, and so that has sort of kept home ownership rates low. They've only come up a little bit off of their lows, but by historic norms, we still are at levels that on a generational basis look fairly low.
You talked a little bit about the lack of suitable office space in New York, for example, and we would be remiss not to talk about the biggest news in real estate over the last few weeks is WeWork and the IPO that did not happen. Still talking about making it happen by the end of the year, but it's the largest tenant in New York. So maybe there's going to be a lot of available office space in really mint condition over the next few months. But generally speaking, we focused a lot on multifamily, but we did touch a little bit on other sectors. What do you think about the other sectors? Are there any opportunities that are going to come from this low interest rate environment, either in office, retail, which is really fragmented and very different from each other, logistics, which has been really hot over the last few years, especially with the last mile delivery.
Yeah, I think your point about industrial and last mile delivery fulfillment centers. Remember, there was a time when we referred to the last mile in the early 2000s. We were referring to how it is that we were going to get broadband internet into people's homes because we were all using dial-up modems, and that was the last mile. The last mile now still has to do with technology, but it's it's about retail, and it's how do we get products to consumers quickly. And in a market like New York, San Francisco, any big market, even secondary markets around the United States, the strongest industrial demand overall has been for urban fulfillment centers. Amazon can get you that tube of toothpaste or that backpack or laptop. The reason they're able to do it so quickly is because it's already very close to you. Now, they don't know exactly what I'm going to order today, but law of large numbers, they have a good sense of what we're going to order collectively. And they make sure that those things are nearby. And Manhattan is littered with urban fulfillment centers where there are products being stored for very, very quick delivery. I think industrial overall, logistics, distribution, warehouse, as long as it's in the right place, it's got the right ceiling heights, it's not functionally obsolete. That industrial overall, including fulfillment, has been the darling of the industry the last couple of years. Everyone loves industrial. So we have to be cautious there. We know under these circumstances that we need to be thoughtful about whether there's too much excitement, whether bidding gets too aggressive. We still have to do our due diligence. We have to do careful underwriting. We've got to do the pro forma analysis. As long as we're not letting the excitement of it all take over and being disciplined, there are wonderful opportunities in industrial. Interestingly enough, on the retail side, if you're a contrarian investor that has a very strong operational capability, I think there are parts of the retail sector that are oversold. There's so much fear and anxiety around retail. it gets painted with such a broad brushstroke. We hear the term retail apocalypse so regularly that I think folks are sometimes losing sight of the fact that some parts of retail, some types of retail have been very hard hit by the move to online commerce. And other types of retail that are truly experiential, that are catering to certain target markets, that are in fast-growing markets, they are performing in a way that does not look like a retail apocalypse. And so I think there are opportunities to come into the retail space. I think the prerequisite, though, is that you have to have a very, very strong retail operating capacity. You have to have a very good sense of what to do with the space to optimize it, how to, what types you have to have a very good sense of what types of retail will come under pressure in the next couple of years and that next wave of repositioning and change. But overall, there's so many dollars coming out of retail, and retail is being treated with such a broad brushstroke that there are opportunities there.
Yeah, and retail is really interesting, especially as we look at, we talk about e-commerce as if it has taken up 100% of retail or commerce, but it's not. The numbers are growing, but
it's where the growth is. Yeah.
Yeah. And at the end of the day, you are seeing kind of that, when you talk about e-commerce, you're thinking about Amazon, you're seeing Amazon opening shops, and you're seeing them buying Whole Food a few years ago to have that brick and mortar's presence. So really important and interesting sector to follow. You've talked about the difficulties of obtaining a construction loan, but speaking about other types of loan and debt and generous, it really has been a fierce competition between the different lenders, if it's bank, insurance companies, and even private funds. Do you think this lowering of interest rate is even putting them in an even more dangerous situation when you look at the imbalance of the risk and return equation that they are facing?
Yeah, I think that the construction loans really are dominated by banks. And so, we're not going to see a construction loan in commercial mortgage-backed securities. There are some lender classes that are some types of lenders that simply are not going to go into the construction space. Overall, banks have remained, fairly disciplined. Some of this is self-imposed. Some of this is regulatory and supervision, by the supervisory authorities. Some of it is that there haven't been as many opportunities to lend. We run a survey with the Real Estate Lenders Association, where we ask, lenders in the market, do they anticipate growth for different types of lending? We ask them sort of where do they see growing demand for loans that are from well-qualified borrowers. There have been some constraints on the growth in demand for construction loans. They don't have lots of folks coming to the table with great opportunities, for construction lending, in part because it's been difficult for the developer, him or herself, to get deals to always pencil out. I think that what we have to be careful of is a scenario where banks are facing so much competition, for stabilized property loans, that they say, let's make more construction loans just because there's less competition there. So we own that space, so to speak, or we dominate that space at least. When we look at the numbers for bank balance sheets, we've certainly seen growth. The supervisory environment has not allowed for the kind of risk-taking behaviors that we observed during the previous cycle. And I think that everyone is keeping there's a lot of scrutiny around banks' exposure to commercial real estate and construction loans, and that will limit some of the risk-taking activity as well.
Good. That's more comforting words from you. I appreciate that. I want to take one step back for the last question from just talking about real estate and talking about capital markets in general. One of the things that we as real estate investors talk about with investors is the lack of correlation or the low correlation between real estate and capital markets, and how that means that even if capital markets go down, real estate usually stays pretty strong, or can stay strong. But the lowering of interest rate is usually not seen as a very good sign for the capital market. It's a way for the government to stimulate the economy and to prevent a downturn. But when we look at the growing margins for real estate investors as a result of this lower interest rate, that's obviously positive for us. So do you think this is kind of a perfect storm between the capital markets and real estate investors?
Yeah, with regard to interest rates, a lot of my focus is on the relatively longer term rates rather than sort of the very, very short term rate. So I'm looking at the shape of the yield curve, and certainly the flattening of the yield curve, the inversion of the yield curve, is a source of concern. With the 10-year Treasury coming down, that does give us a little bit more room. I don't really see cap rates coming down, because I think investors do see that while the underlying cost of risk-free, the required yield for the risk-free investment is lower. It's in anticipation of there being weakness in the broader economy.
Yeah.
And right now, folks are, I think, mindful enough about the possibility, perhaps even we could say the likelihood of a downturn in the broader economy at some point in the next 18, 24 months, that's limiting some of the competition for assets that would potentially push cap rates lower. So we don't really see them going down materially. They're definitely going to be, they're always going to be sort of the odd deal that that's priced aggressively. Yeah. But overall expectations for appreciation in terms of asset values over the next couple of years are more limited than what we've seen, over the course of let's say the strongest years of this cycle.
Great. So Dean Sam Chandan from the Shack Institute at NYU, thank you very much for the time you spent with us today. And we hope to see you soon in Israel, both for business and for pleasure.
Thank you so much. See you soon.
Thank you.